I'm going to be straight with you right now. When I say you can build a seven-figure real estate portfolio on a military salary, I'm not talking about a unicorn investor with a trust fund and a side hustle. I'm talking about a service member who is disciplined, made the right three decisions in the right order, and compounded from there. So let me show you exactly what those three decisions were. If this is your first time here, do me a favor, help me out with the algorithm, hit like, subscribe, tap the notification bell, and share this with your friends. I publish straight talk on real estate investing for veterans and first responders who want the unfiltered version with no hype, no filler, just execution, and no sales pitch. My name is Bud Evans. I'm a 35-year United States Air Force veteran, 13 years in law enforcement. I'm a former mayor of Cinnaminson, New Jersey. I'm an active real estate investor across 3 states in single-family and multifamily properties, the founder of a low-cost, investor-focused property management company here in South Jersey. I mentor veterans and first responders in real estate. That's my background, and that's why I'm here. All right, before we get started with the right stuff, let me tell you what the wrong version of this story looks like, because most veterans I talk to are living some version of it right now, and they really don't even fully realize it. A service member joins at 18 or 22. They're disciplined, they show up, they execute, they get promoted, they build a career that most civilians would respect enormously. And somehow around year 10 or 12, they start thinking seriously about money, about what happens after the military when they realize TSP and your pension isn't enough, about whether or not you're going to be okay. So they do what we're told to do. They max out the contributions on their TSP. They stay out of debt mostly. They live on base, or they buy a house near whatever installation they're assigned to, and they're responsible and they're doing the right things. And then they retire, or they separate. And they look at the financial picture they built over a decade or 2 decades of honorable service, and they realize something is uncomfortable here. The discipline was there the entire time. The income was there. The benefits were there, but the wealth is not. Not the kind of wealth that creates options, not the kind of wealth that changes your life, and not the kind of wealth that means the next chapter of your life is genuinely financially free. You have a pension, maybe. You have a TSP balance, which is okay. And you might have a house with some equity. And you have a slow realization that none of those things alone or even together is going to give you the financial independence that you actually want. That realization will hit you hard, because it's not the result of laziness. It's not the result of bad character. It's the result of following the advice that's designed for the median civilian, not for a service member with a unique set of financial tools, benefits, and opportunities that most civilians will never have access to. The military gave you tools that the civilian world doesn't get. The VA loan, BAH, stable income during a period of life when most civilians are scrambling, the ability to buy real estate in multiple markets across a career because the military moves you all the time. These aren't small advantages. These are significant wealth-generating tools that are sitting in your kit the entire time you're serving. And most veterans either just don't know about it or nobody showed them how to use it. Here's where the conflict becomes real and measurable. An E7 with 15 years of service who used their VA loan once to buy a primary residence and then sold it at the next PCS left a significant amount of money on the table. Not because they made a bad decision in isolation, but because nobody connected the dots for them. Nobody showed them that each VA loan use, each PCS duty station is a new potential acquisition event and long-term wealth building strategy. Now here you are at year 20, retirement's 3 years away. And the window to use your active duty advantages, your stable income, your BAH, your commissary savings, your health care, to underwrite real estate acquisitions is closing fast. Every year you did not act while on active duty is a year of compounding that you've lost and you'll never recover. That's the real cost here. It's that opportunity cost. It's not the money you spent. It's the compounding that you never started. And the veterans who figured this out, the ones with 7-figure portfolios built on an E7 or O4 salary, didn't do anything exotic. They didn't flip houses. They didn't syndicate commercial deals. They didn't find some secret strategy that nobody else has access to. They made 3 decisions in the right order, and they stayed disciplined about it for long enough that compounding did the heavy lifting. So these are the three decisions that the rest of this video is going to be about. Before I get into the breakdown, let me explain this to you. If you are a veteran who wants to be around people who have already made these decisions and are executing right now, I invite you to get into the War Room with David Perret. It is a veteran-specific real estate community built by somebody who's done exactly what I'm describing in this video. It's the room I would want to be in if I were starting this all over again, and I've been a member for 6 years. So there's a link in the description. Get in. Now, if you want to work with me directly, go to budevans.com. There's a one-off opportunity for a coaching call should you need it. I don't have a program. So let's start with these decisions. Decision one, use the VA loan as an acquisition tool, not just a home buying benefit. This is the first and most important reframe here. Most service members think that the VA loan is a way to buy that house they currently live in. That framing is limited and it costs you enormously over a full career. The VA loan is a zero down, no PMI, federally backed loan with competitive interest rates. When you use it to buy a property you intend to live in, you're using it correctly by the letter of the program. But when you understand that you can use it, move out due to PCS orders, convert the property to a rental, or in most cases, restore your full entitlement to use it again at the next duty station, this tool becomes something entirely different. It becomes a repeatable, low-cost acquisitions mechanism. Now, here's the sequence that veterans with strong portfolios actually used. You arrive at a new duty station. You use your VA loan to purchase a property. You intend to live in it. You do live in it. You take care of it. You treat it like the asset was not just a home. When orders come, instead of selling, you convert it into a rental and you place it with a vetted property manager, and then you leave. And at the next duty station, you explore whether your VA entitlement was restored or you have a remaining entitlement to use again. Not every situation is going to allow you to use this exact sequence. Entitlement restoration depends on the loan balance, the property situation, and current DA guidelines. I'm not giving you legal or financial advice here. I'm giving you the framework that I've seen several serious investors make, and I'm telling you to sit down with a VA knowledgeable lender before your next PCS to understand your exact position. That conversation costs you nothing, and it could be worth hundreds of thousands or even millions of dollars over your career. The mistake that most service members make is not having that conversation. They assume the VA loan is a one-time benefit. It's not. It's not structured that way at all. But you have to ask the right questions to understand how to use it correctly across multiple transactions. Step one of decision one, before your next PCS, talk to a lender who specializes in VA loans and ask them specifically about your current entitlement position and what options exist for your next acquisition. Don't just assume, get the actual numbers. Right. Step two, when you're evaluating your next purchase at the new duty station, underwrite it simultaneously as a primary residence and a future rental. I covered this framework in a previous video. The property has to work as both, or you're setting yourself up for forced sale at the next PCS. And that's not the goal here. Step three of your first decision. Stop thinking of each duty station as a fresh start financially. Start thinking of each duty station as an acquisition event in a multi-decade wealth building strategy. The mindset shift here is everything. Once you see it that way, the decisions that you follow get easier and cleaner. Overall, decision two. Treat BAH as a capital deployment tool during the years that you live either on base or in government quarters. On base, guys, get off base, okay? This is the decision that's going to separate the investors who build fast and the ones who build slow. And it's available to every service member who chooses to live in government-provided housing. If you're using your BAH to live in government housing, you're not going to gain equity at all. When you live in base or in government quarters, you're not receiving BAH as a housing payment. You're potentially receiving it as income depending on your specific situation and installation. That money, if managed with discipline, becomes your acquisition capital, but we all know how that really works. An E7 receiving BAH in a mid-cost market and living in government quarters is potentially accumulating meaningful capital every single month, and that service member paying rent or mortgage in town is overspending. Over 3 years at a duty station, that difference is substantial. Over a full career with multiple duty stations, it's a portfolio-defining advantage. Veterans who built seven-figure portfolios on listed salaries almost universally did it with one of the two things in this opportunity. They either used some form of housing specifically to accelerate their capital accumulation for real estate acquisitions, or they house hacked their way to generating income while keeping their own housing costs minimal. Both strategies require discipline, neither requires high income. Here's step one of decision two. Calculate exactly what you're currently doing with your BAH or your housing savings if you're in government quarters. If it's sitting in a checking account, guys, is it funding lifestyle? Is it being directed towards a specific acquisitions goal? You got to know that answer. If the answer isn't specific acquisitions, change that now. Step two of decision two. Open a dedicated capital account separate from your personal accounts. Label it as an acquisitions account. Every dollar directed towards real estate acquisition goes into that account and only comes out if you're buying real estate or, property specific reserves. This is your deployment fund. Treat it like one. Step three of decision two is set a target capital threshold for your first acquisition and timeline to hit it. If you need $15,000 for your first conventional down payment and you can direct $700 a month towards your capital, you're 21 months from your first deal. That's a real timeline. It's not fantasy. It's an operational plan. But guys, if you're saving all that money and you can use the VA loan, use it. Let's talk about decision 3. Build the management infrastructure before you need it, not after. This is the decision that's going to determine whether the portfolio you build is an asset or a liability. And it's the decision that most veterans skip because it feels like overhead before they do anything, before they even have anything to manage. Here's why it's actually the most leveraged decision you can make. When you build your management infrastructure at door 1 or door 2, you build it under low pressure conditions. You have time to vet your property managers. You have time to establish systems for tenant screening, maintenance, oversight, and financial reporting. You have the time to make small mistakes and correct them without catastrophic consequences. When you try to build management infrastructure at door 6 or door 7, because you finally got big enough that you really can't ignore it anymore, you're building it under pressure. Now you're making fast decisions about who to trust with your assets because you don't have time to vet properly. And we all know slow is smooth, smooth is fast. Don't be retrofitting systems on a portfolio that has already developed bad operational habits. And you're already doing all of this while simultaneously trying to manage the day-to-day problems of a portfolio that has no systems yet. I've watched investors who have built 5 or 6 doors with no management infrastructure, and then they spend the next 2 years unwinding the damage from that decision. The time they spent cleaning up the operational chaos cost them more than the time it would have taken to just build the systems correctly at door number 1. Let's talk about step 1 of decision number 3. Before you close on your first property, identify and interview at least 3 property managers in your target market. Use the vetting criteria that I covered in the property management video. Check the references, go one layer deeper, establish the relationship before you actually need it. Step 2 of decision 3 is build your tenant screening criteria before you have a tenant to screen. Minimum credit scores, income to rent ratio requirements, rental history standards, criminal background check policies. This all needs to exist in writing before the first application even comes across your desk. Making screening decisions on the fly without written criteria is how fair housing violations happen by accident and how bad tenants get placed. Step 3 of this third decision is establish your financial reporting and reserve account structure at door number 1. Dedicated property accounts, itemized expense tracking, monthly reconciliations, reserve account funding schedules. These systems are a lot easier to build at door number 1 than it is to retrofit at 10. Fourth step of the third decision. Document everything from the first day of your ownership, every repair, every vendor, every communication, every lease term. This documentation legally protects you in disputes, your performance data for future acquisitions, and your operational record if you ever dull the portfolio. Veterans understand documentation, and so do judges. Apply the same standard to your portfolio that you applied to your unit. Here's what the full 3 decision sequence looks like when it's executed correctly across an entire military career. So a service member makes a decision at, decision 1 at their second duty station. They convert their first property into a rental instead of selling it. They buy again with their VA loan or conventional financing, and they repeat that conversion at the next PCS. They make decision 2 at the duty station where they have access to government housing. They accumulate capital aggressively for 2 to 3 years, and they deploy that capital into their next acquisition. You make decision 3 before your first rental is even placed under management. You build systems that scale. You vet your property manager at door number 1, so you trust them completely at door number 5. By retirement at year 20, you don't just have one house and a TSP balance. You have a portfolio of 5, maybe 8 properties that are generating consistent monthly cash flow. You have a pension that covers your baseline expenses and the financial position to choose what the next chapter of your life is going to look like without being driven by income. You're no longer trading time for money. That is the 7-figure outcome. It's not luck. It's not a side hustle. It's not a trust fund. It's just 3 decisions that, made in the right order with military discipline, applies to execution. All right, let's talk about common mistakes. These are the things that really break down the sequence. Mistake number 1 is waiting to separation or retirement to start. I did that. That's a mistake. Every year of active duty, you don't act as a year of compounding. Your VA loan access, your stable income, your underwriting, your BAH capital accumulation. You can't recover that. Start now, regardless of how many years you have left. Mistake number 2, making decision 3 last instead of first. Most investors build the portfolio and then try to build the infrastructure. This correct sequence here is infrastructure first, then acquisitions. Systems before scale. Remember, slow is smooth, smooth is fast. Mistake number 3, using BAH capital for lifestyle upgrades instead of acquisition capital. The discipline that makes you effective and uniform is the same discipline here that builds your portfolio. Apply it to your capital account with the same standards you apply to everything else in your life. Mistake number 4 here is treating each PCS as a financial reset instead of a strategic acquisition event. Every duty station is an opportunity. Every PCS is a new decision point. The veteran who builds the wealth sees the career as a sequence of strategic moves. The veterans who don't see each move as starting over. Mistake number 5, going through this process alone without a community of investors who are further down the road than you are. The mistakes I just described are not new mistakes. They're the same mistakes that have been made over and over and documented by veterans who went before you and want to help you. The fastest way to avoid those mistakes is to get around people who've already made them and can help you correct your cost. Of course, don't pay the tuition on lessons that have already been learned. As always, here's your recap checklist. So use this as your 3 decision execution guideline. Contact a VA knowledgeable lender before your next PCS and get your exact entitlement position in writing. Underwrite every property purchase as both a primary residence and a future rental before you close. And house hack it if you can. Calculate exactly what you're going to do with your BAH or your housing savings and redirect it towards a specific acquisition goal if it's not already there. Open a dedicated capital account this month and start establishing a monthly funding target towards your first or next acquisition. Build your tenant screening criteria in writing before you have a tenant to screen. Vet at least 3 property managers in your target market before you even close on your first property. Next, establish your financial reporting structure, your reserve accounts, and your documentation system at your first door. Stop treating each PCS as a financial reset and start treating each duty station as an acquisitions event in your long-term strategy. Get into a community of veteran investors who are executing the right strategy now. Don't build in isolation. And then review your portfolio plan annually and adjust your acquisition pace based on your current entitlement position, your capital availability, and market conditions. Hey, if this gave you a framework that you can start executing immediately, do me a favor, hit like, subscribe, tap that notification bell, and share this with other veterans and first responders. This is what I put out every week for veterans and serious investors who want real answers and real execution. Thanks for watching. I'm Bud Evans. Aim high, execute fast. See you on the next one.